The American dream is being priced out. In 1950, the average American home cost about 2 times the average annual income. Today, in many cities across the United States, that number is closer to 7, 8, even 10 times income. For decades, Americans were told a simple story: work hard, buy a home, build equity, pass it down. That was the American dream. But something has shifted. Not suddenly, not dramatically, quietly. And when economic shifts happen quietly, they are often the most powerful. This isn't a story about collapse. It's a story about structure. Because housing is not just about real estate. Debt is not just about borrowing. Ownership is not just about property. Together, they form the foundation of how Americans build stability. And that foundation is changing. Over the past few years, the cost of living in the United States has reached levels that feel unfamiliar to many households. Mortgage payments have climbed sharply as interest rates rose. In cities like Austin, Miami, Phoenix, Los Angeles, and New York, rent has absorbed 40 to 50% of median household income. Car payments now average more than $700 per month. Credit card interest rates have crossed 20%. Student loan repayments resumed. Healthcare premiums continue to rise. Groceries, insurance, utilities, all higher than they were just a few years ago. Individually, each increase can be explained. Together, they create pressure. Pressure changes behavior. Previous generations often used debt strategically. A mortgage built ownership. A business loan built income. Student debt increased earning potential. Debt was tied to upward mobility. For many Americans today, debt is no longer a ladder. It feels like a treadmill. You run harder, but the scenery doesn't change. And when housing becomes less attainable, the emotional impact goes far beyond economics. Because home ownership in America was never just financial, it was psychological. It represented arrival, security, belonging, control. Without ownership, long-term planning becomes uncertain, and uncertainty slows confidence. To understand how we arrived here, we have to look at what changed after 2008. The financial crisis reshaped housing permanently. When home prices collapsed, large institutional investors entered the market aggressively. Private equity firms, asset managers, corporate landlords, they began purchasing single-family homes at scale. Not dozens, thousands. In some metropolitan areas, institutional investors now own significant percentages of available housing inventory. Why would corporations buy houses? Because in a low interest rate environment, real estate became a yield-producing asset. When borrowing costs are near zero, large capital pools can outbid individual families. Cash offers became common. Inspection contingencies disappeared. Speed replaced patience. For a first-time homebuyer, competing against the corporation with algorithmic pricing models and institutional financing is nearly impossible. This isn't a conspiracy, it's capital allocation. Homes became financial instruments, and when housing shifts from shelter first to asset first, affordability becomes secondary. For those unable to buy, renting becomes the default. But renting is no longer stable. In many American cities, rent surged double digits within short periods. When half your income goes to housing, financial flexibility disappears. Savings shrink, investment pauses, family planning delays, risk tolerance changes. The American dream begins to feel like a subscription service. You pay monthly, but you never build equity. And here's where it becomes structural. When large investment firms own increasing portions of housing supply, rental pricing power consolidates. Technology optimizes pricing. Markets synchronize faster. Volatility increases. The renter absorbs the adjustment. Zooming out, the national picture adds another layer. The United States carries over $40 trillion in federal debt. By itself, that number does not mean collapse. The U.S. economy remains one of the largest and most productive in the world. But interest payments on that debt are rising. At the same time, household debt across mortgages, auto loans, credit cards, and student loans totals trillions more. Modern economic growth in America is deeply connected to credit expansion. Consumption drives GDP. Credit fuels consumption. When interest rates remain low, the system expands comfortably. When rates rise, pressure surfaces. Servicing costs increase, refinancing becomes harder, spending slows, growth moderates. Again, not collapse, adjustments. But adjustments feel heavier when households are already stretched. And then there is the psychological divide. Ask many baby boomers about their first home. You'll often hear stories of purchasing in their 20s. Modest down payments, stable long-term mortgages, property appreciation over decades. Now, ask many millennials or Gen Z Americans. You'll hear about saving for years while prices move faster than savings. You'll hear about bidding wars, corporate competition, high student debt balances, rent consuming half of take-home pay. This is not about one generation working harder than another. It is about timing. Asset inflation has significantly outpaced wage growth over extended periods. When asset prices rise faster than incomes, entry barriers increase. When entry barriers increase, ownership delays. And when ownership delays, wealth accumulation slows. That gap compounds over time. Housing is only one layer of a broader transformation. The deeper shift is happening in ownership itself. For most of American history, wealth was built through tangible ownership: land, homes, small businesses. Today, ownership is increasingly centralized. Index funds own large portions of corporations. Corporations own housing. Private equity owns infrastructure. Technology platforms own marketplaces. Meanwhile, everyday Americans increasingly access rather than own. They stream instead of buy, lease instead of purchase, finance instead of save. Subscription models replace permanence. Convenience replaces control. Access replaces equity. This transformation makes life flexible, but it also concentrates long-term asset growth. And when long-term asset growth concentrates, inequality expands gradually, not explosively, quietly. Interest rate shifts reveal this reality clearly. For over a decade, ultra-low rates fueled asset appreciation. Homes appreciated, stocks appreciated, debt expanded, confidence grew. When inflation returned and rates rose rapidly, structural sensitivity became visible. Mortgage affordability dropped sharply, auto loan terms extended longer, credit card balances grew more expensive, small businesses faced higher financing costs. Cheap money had supported elevated valuations, expensive money tested. And when affordability tightens across multiple categories at once, households feel squeezed from every direction. What happens if nothing fundamentally changes? The United States does not suddenly implode. Instead, gradual trends continue. Home ownership rates stagnate, corporate rental portfolios expand, debt servicing consumes larger portions of income, wealth gaps widen incrementally. Political debates intensify, policy proposals emerge. Some adjustments will happen, they always do. Markets adapt, regulations shift, cycles turn. But the long-term trajectory depends on one critical factor: whether ownership opportunities expand again for the middle class. Because the American dream was never purely about income. It was about ownership, ownership of property, ownership of opportunity, ownership of time. Ownership builds stability. Stability builds confidence. Confidence builds growth. If ownership narrows, confidence weakens. And confidence is the invisible infrastructure of any economy. Every generation faces defining economic conditions. For the post-war generation, it was expansion and suburbanization. For later generations, it was globalization and technological acceleration. For millennials and Gen Z, it may be navigating a financialized economy where assets appreciate faster than wages. This does not mean decline, it means restructuring. Restructuring creates winners and losers depending on positioning. The essential question is not whether America survives. It will. The question is who participates in asset growth going forward. Will housing become accessible again relative to income? Will wage growth accelerate sustainably? Will policy encourage decentralized ownership? Or will subscription-style living become permanent for a larger share of the population? These are not emotional questions, they are structural ones, and structural trends shape decades. The silent debt crisis is not dramatic. It does not unfold overnight. It builds through ratios, through interest payments, through affordability gaps, through ownership consolidation. It builds slowly, and slow shifts are often underestimated because they lack spectacle. but what lacks spectacle often defines eras. The American dream is not dead, but it is being renegotiated, and renegotiations determine who benefits in the next cycle. Understanding that shift is not about fear, it's about awareness, because awareness allows adaptation, and adaptation determines outcomes. If these conversations matter to you, if you want deeper analysis on housing, debt, ownership, digital finance, and the economic structure shaping the United States, subscribe, because the next decade will not be defined by headlines alone. It will be defined by structure. And structure is what shapes the future of the American dream.